My name is Roger Barker. I'm Director of Policy and Corporate Governance at the Institute of Directors in the UK, and I'm joined by my colleague Chris Hodge, who is a senior advisor to the Centre for Corporate Governance, which is run by the IoD. We're very happy to give you a run through of what UK corporate governance is all about. And I think we're planning to do this through a mixture of talking about the kind of legal and regulatory frameworks which apply in the UK, and also interspersing that with a few recent high profile case studies, which have been very influential in terms of how policy is developing and how therefore it's likely to move within the next few years. But let me turn first of all to Chris. Hello, Chris. And I'm just going to turn to you so that you can start off by laying out the foundations of UK corporate governance.
Thanks, Roger. Hello, everyone. Nice to see you all, or at least be speaking to you all. And I recognise at least 2 or 3 familiar names in the list of participants. So good to know some old friends are out there listening. As Roger said, I'm a senior advisor of the Corporate Governance Centre at the IoD, which is something that was set up a couple of years ago to focus on do some thought leadership and dig into some aspects of governance that perhaps haven't been explored in the extent that they might have done. We've recently published a report on the link between governance and innovation. And if anybody's interested in that, please just put the name in the chat and we can, via Carillion, I'm sure, send a copy of that to you. Previously, I was at the FRC, the Financial Reporting Council, who you can see on the slide there, and they're the regulator responsible for governance and investor stewardship. And for 10 years, up until 2014, I was in charge of the UK Corporate Governance Code and the Stewardship Code for investors, which I'll explain a little bit more about. Now, more recently, through some of the development banks, I've also worked in other countries to help them develop their national codes and reporting standards, usually in Eastern Europe. So it's been interesting for me to compare things that you perhaps take for granted as being part of the governance framework in your home country, you find don't work quite as well elsewhere, and this reinforces the view, which I'm sure comes through from these sessions that Carillion organises, that while there are certain things in common, there are also distinctive national differences and very good reasons for that as well. So as Roger said, I'm going to start by talking a little bit about the legal framework. So I've got a fly buzzing around in front of my head. So if you can see my hands moving, that's the reason. And then the sort of basics of the common features of UK governance, as it has been until the last few years. At that point, I'll then hand over to Roger for the exciting case studies that he mentioned. So that's the glamorous bit of the presentation. And then we'll come back to some of the developments that have been happening in the last few years. We've kept those till the end because, in part, some of them have been inspired by the 2 case studies that Roger is going to talk about. So I think they're a useful context for talking about some of the recent changes. So getting onto the framework, I mean, we have, as I expect many of you have, in your countries, a distinction between things that are in the law and things that are in codes and listing rules. As I said, primarily the director's duties are set out in law. There are some reporting requirements which are growing as governance and ESG and sustainability in particular become more prominent, and we'll talk about those a little bit later. The Financial Conduct Authorities are securities regulator, and it is a separate body to the Financial Reporting Council, which regulates governance, stewardship, accounting, and auditing. That split came about nearly 20 years ago now, when they first decided to set up an independent regulator for the audit and accounting profession. And it was decided at the time that the code belonged there rather than with the securities regulator. However, the listing rules, which in the UK are the responsibility of the securities regulator, not the stock exchange, which I think may be different to some other countries, do set out a requirement that if you have what's called a primary listing, which is the main market in London, then you need to comply or explain with the corporate governance code. And I'm sure I don't need for this audience to explain what comply or explain means. It's something that was first devised when the code was introduced here. We have apply and explain, or apply or explain in other jurisdictions. There are more detailed governance requirements set out in the other part of the FCA's rules for banks and large insurance companies. That's quite a distinction between the way in which this happens for other listed companies, in that there is a great deal of prescription about some of the governance aspects for that particular sector, given their importance to the economy and their systemic importance. But that isn't matched for other companies. And there's also they also regulate institutional investors, insurance companies, and so on. And they have the so-called conduct of business rules, and the conduct of business rules, in the same way as the listing rules say companies must comply or explain with the UK Corporate Governance Code, they have a similar obligation for investors to say whether or not they're applying the so-called stewardship code, and if so, how they're doing so. Moving on then to the third part of the main framework, the UK Corporate Governance Code, I've already mentioned. It was the first national code, narrowly beating the South African King Code, but those two between them have sort of, for many years, set the agenda. The UK code traditionally has been focused more on a narrower definition of governance in terms of the internal governance arrangements of the company, rather than the broader ESG agenda. It was very much a product of its circumstances, because it was brought about in response to a series of financial scandals here back in the late 80s and early 1990s. South Africa, obviously, the context behind in which the King Code came around was very different, and has that broader, has always had an element of what you could broadly call ESG involved in it. And certainly, as we'll say, our UK code is now heading in that direction much more explicitly as well. Relatively recent introduction, and Roger might want to say a bit more about this as he was involved in the committee that drafted these, is a thing called the weights principles, named after the person who chaired the committee. And that is a simplified set of principles compared to the code for listed companies that is for large private companies. And this is now a requirement for companies over a certain size to report on their governance. And this is one of the reporting requirements that's now part of law. We can get into that perhaps in more detail later, because it's a direct consequence of one of the two case studies that Roger will be talking about. And then finally, we have the UK Stewardship Code. This is something that, again, I think the UK was the first country to have a national stewardship code, and I was there at the FRC at the time it was introduced. The intention was to try and reinforce the comply or explain approach to corporate governance by ensuring that investors were listening to, engaging with companies about their governance arrangements. There are now something like 20 countries around the world which have an equivalent code, again, South Africa being, I think, one of the early countries that moved to introduce such a thing, the CRISA code it's called in South Africa. So that's the main structure. As it says there are many other sectoral codes. IoD has good practice principles for smaller private companies, which again are designed to be suitable for the relatively simple governance arrangements that such companies had, at least in comparison with large private or listed companies. And there are many sectoral codes as well. So that's the basic structure. I don't know whether Roger.
Yes, Chris, maybe I could just add. I mean, as I'm sure everyone knows on this call, the UK is no longer a member of the European Union. So unless you've been living under a rock somewhere, I'm sure you kind of failed to have noticed that. And of course, up to the point where the UK left the EU, EU law was, of course, being incorporated into the UK legal framework, and it was certainly affecting quite a bit of this stuff that Chris was mentioning, although not the corporate governance code, because the EU never got to a point where it required all EU companies to adhere to a single code. That even today, corporate governance codes are nationally developed and derived, but a lot of the other parts of the framework sitting under the Financial Conduct Authority hat, and also national law, has been influenced by EU sort of legal developments. Although, of course, going forward now, we might start to see some divergence between the UK and the EU and maybe Chris will have a bit more to say about that. But Chris, I'll just move you on to the next slide.
Okay, no, that's a good connection, Roger, because the first point, well, the second bullet on this point is actually linked to that. I mean, a lot of the reporting requirements that are in UK law and have been retained in law were derived from European Union obligations, although so far, and we'll come back to this, that the government has decided to retain them. So there's a lot of detail about what they so-called non-financial reporting is the area. There is very little, though, even today, in the law itself, either from national or EU law, which specifies the governance structures that a company has to have. As you'll see on the bullet below that, there is no requirement in law to have a particular structure of the board, a sort of one-tier or two-tier board, although certainly amongst listed companies and the majority of private companies, the common practice is the single-tier board. There's no requirement to have independent directors in law. There are currently no diversity requirements in the UK law either, at least in terms of board membership. The one area that is mentioned in law, and this is a European Union law, is the audit committee. So slightly, and there are requirements to have independent members on the audit committee, even though there's no requirements to have independent members on the board. So it's a slightly sort of odd situation where you've got a very loose framework in law, at least around the board, but you've got this quite precise requirement around the audit committee. Worth saying, the first bullet is a bit of an oversimplification, and we'll come on to this later, and Roger is extremely well qualified to talk about this particular point. The wording in the law in the UK, in contrast to certainly many companies many in the countries in the EU where the director's duties are to the company. In the UK law, it's defined as being to the members of the company. And what that has sometimes been interpreted as, and it's an active debate here at the moment, is that the interests of the shareholders must take primacy over the interests of other stakeholders, and sometimes even, some would argue, the long-term interests of the company. And this has become quite a source of friction. There are requirements in the UK law, which you might call subsidiary duties, which state in acting in the interests of the members of the company, you must take into account the interests of other stakeholders, such as the workforce, suppliers, local communities, the impact of the environment, these sort of things. But there is a view that because of the way the wording is framed, these haven't been given sufficient attention or sufficient weight sometimes by boards when making their decisions and judgments. As I say, this is a very active debate in the UK at the moment, so we'll come back to that in more detail later. The next set of bullets from independent directors downwards are primarily relating to to listed companies. And one thing that is unusual, I think it still may be unique, was something that was introduced to the UK code around about 10 years ago now. I ought to remember because I was there when it happened, which is that the directors of listed companies are put up for re-election every year. It's comply or explain, but everybody complies pretty much with this. In practice, it's not really had much of an impact. The thinking behind it was to try and make directors more accountable. It was when we were having one of our many regular worries about executive pay, which is a perennial issue in the UK, and it was felt that if the directors concerned, the chair of the remuneration committee, for example, felt more under pressure to meet shareholder expectations by being up for re-election every year, then they might be more responsive to shareholders' concerns. In practice, the UK, there's barely more than a handful of directors lose their seats across the whole of the UK listed sector every year. The vast majority of directors get back with 90+% support. And in terms of the way the company's organised, this, people are appointed on a 3-year term subject to annual re-election. So the actual difference in practice is very little. Diversity, as it says there, there's no, unlike some European countries, there is no quotas at the moment, but the Corporate Governance Code does require companies to state what their levels of boardroom diversity are and what they're doing to increase them. And there are a number of business-led initiatives here promoting specifically gender and ethnic diversity, which have had some impact, although the people supporting those campaigns would probably say not enough impact in their view. Certainly, we've seen a large increase of non-executive directors, female non-executive directors in particular, very little shift in terms of executives, unfortunately. Workforce representatives, again, this is a difference between some countries in Europe where there are requirements or either to have representatives on what's called the supervisory board, as in Germany, or for companies above a size, at least there's a law requires them to give the workers the option of having representation on the board, which isn't always taken up. That's not something we typically see in the UK, at least not in listed companies. I think there are no more than 3 or 4 listed companies that currently have workforce directors on the board. The Corporate Governance Code has been pushing for more representation, and it does have some requirements for companies to explain how they take account of workforce voice or worker voice. And one of the options that's in the code is a worker representative, but very few companies, as I say, have taken that up. One can speculate on what that is. I think partly it's sort of a historical memory of battles with the trade unions many hundreds of years ago that perhaps hasn't quite left us, and maybe a bit of old-fashioned class snobbery in the UK. As I mentioned, directors' pay is the one issue that is always top of the agenda when it comes to governance, and has been for at least 25 years now, dating back to when old nationalised energy companies were privatised, and all the directors immediately gave themselves an enormous pay increase. And every couple of years there'll be more law and more focus on this, and the law keeps getting more and more prescriptive, but it doesn't seem to have made any basic difference to date, to be honest. The other area that's worth mentioning here, and the last 3 bullets concern this, and then I'll hand over to Roger for the case studies, is the role that investors play in the UK market. And I think this is partly important because we wouldn't have come up with a comply or explain mechanism in the early 1990s without the expectation that investors would play that role. And there were a number of features of the UK market at the time, which was an absence of controlling shareholders, or a virtual absence of controlling shareholders. Obviously, a comply or explain, if you're complying or if you're explaining to yourself, it doesn't work terribly well as a means of oversight. But also there were a lot of UK insurance companies and pension funds who had a significant share in the UK market. At that point, they owned something like 65% of the UK market. And so it was felt that they were in a position to actively engage and monitor UK companies in which they invested, and that collectively they had the strength, even if they individually weren't controlling shareholders, to influence companies' management. So that was part of the thinking behind the comply or explain system. And one of the things that has changed significantly since then is the growth in foreign ownership of the London market. It's well over 50% is now owned by non-UK investors. And again, there is a debate about whether that change in the ownership base in the UK has meant that the comply or explain approach is less effective, particularly if you're owned by investors who may not know the company terribly well because they're not domiciled in the market. And in the case of the large owners like BlackRock and Vanguard and so on, have tens of thousands of investments around the world and don't really have the resources to monitor them more closely. So those are the main features. I don't know whether anybody has any. I've not been keeping up with the chat a bit. But,
Chris, we have a couple of questions actually. Let's address these before we move on. So the first question is from Paul Druckmann, who quite rightly states that within the Corporate Governance Code, the UK Corporate Governance Code, it emphasises the fact that it's the duty of the board to create the long-term success of the company, generating value for both shareholders and contributing to wider society. So that, in a way, seems slightly to conflict with what we were saying about the shareholder primacy in UK companies. But Chris, how would you address that question?
No, I mean, I agree with Paul, and that's, I mean, we were going to come on to later this very discussion, because there is a campaign that the IoD supports in the UK called the Better Business Act, which is trying to get the wording of the law to perhaps be better aligned to the wording of the code. Shall we put it? I mean, I think the code is better worded than the law.
Yes.
I mean, my own view is that the law doesn't actually mandate shareholder primacy. I think what has happened, though, is that it has been widely interpreted as meaning that, because of the way it's structured. I mean, for a bit of history, the law was updated in 2006, and it has this current structure. It says members of the company, and then here are the other things you need to think about. At one point, it was discussed having each of those as separate legal duties. So the directors would have a duty to the members of the company, they have a duty to the workforce, to their suppliers, and so on, until somebody pointed out that if you had them all as separate duties, you were inevitably putting directors into a position where, in order to meet their legal duty in one area, they'd have to break it in another, because it's not always possible to deal with all of these interests. So they came up with this formula. As I say, my own view is that it's been treated as shareholder primacy, even if it's not technically shareholder primacy, and hence the desire to clarify the wording in the law to bring it more in line with what I think everybody agrees is the wording, the better wording that the code has.
Just perhaps to add to that, Chris, I mean, in a way, this reflects one of the challenges of having different components to a corporate governance framework. So one has the company law, and that states the duties of directors in terms of their fiduciary duties. And then another piece of the jigsaw is the corporate governance code. Now, as Paul Druckmann rightly points out, I think that the code has been a more dynamic, as it were, part of the regulatory framework. It's been possible for it to evolve quicker, to reflect, as it were, growing societal concerns about what the objectives and purpose of a company is and what the duties of directors should be. And so I think that the code has been moving, I would say, more quickly in a pro-stakeholder direction. Whereas company law, of course, is something which changes certainly in terms of statute quite rarely. As Chris said, the last piece of major company law legislation that we have is the Companies Act 2006, and there are moves to try and update that, because I mean certainly the IoD believes that it is now looking a bit dated, and it isn't even if it does leave a lot of room for interpretation, it probably is best updated to reflect how society is evolving in terms of expectations, and that's why we are lobbying for a change to company law.
I mean, I think just very quickly on as I said, that one of the things the UK has got right, and we've got many things wrong in this area, is that most of the detail of what governance should look like in practice has been left to the code, and I think that's a conscious decision to try and avoid being too prescriptive, partly for the reasons that Roger said, that it's difficult to change if it's in the law, but also the recognition that even in the listed sector, there are many different companies with different sizes, structures, and so on. And to be overly prescriptive in law, you need to set it at such a low level that it's not really worth bothering about. The distinction I was tried to make when I was presenting these was to say that the law sets the absolute bare minimum below which you should not go. The code sets more aspirational standards, which we hope all companies will aspire to. So, and I think, yes, by and large, with the obvious exception of remuneration, I think the UK has done fairly well in keeping the detail in the codes, so there's greater flexibility. So,
we now have a question from Boon Yi Lai, who asks, what's the difference between independent and non-independent directors and the definition of each respectively? So there, I would point you to the UK Corporate Governance Code, because that's where the definition of director independence is stated in the UK. I know that that's something that can vary quite a bit between countries. So, for example, in the United States, the definition of independence will be found within the listing rules. But No, with the definition that we have within the UK Corporate Governance Code, it's a list of criteria for independence. Some of the highlights are that you mustn't have sat on the board for longer than 9 years. You mustn't have any existing connection with the company or its key shareholders or key officers. And yeah, there are a range of other ones as well, Chris. Can you think of any of the others that are on
Well, I
that
think
list?
the main two areas, and we can come back to the so-called 9-year-old, because this is, I mean, all codes, all countries have some definition of independence. In the UK, it's primarily, as you say, independence from the management, as we don't tend to have controlling shareholders, at least in listed companies. In the main criteria is that you should be independent of the management of the company, but there are other more detailed things. If you've had an ongoing working relationship with the company in different capacity, that might, if you're financially dependent on the company in some way or other, that again may differ. Whereas a lot of the countries I work in, Eastern Europe, for example, it's most common for companies there to have the controlling shareholder. And in those circumstances, the primary purpose of an independent director is to have someone who isn't a representative of the controlling shareholder there to represent the minority shareholders. The most controversial bit of the UK definition is the one you mentioned, Roger, which is that it says that if you've been on the board over 9 years, you're no longer considered to be independent. Now, every director you meet who's been there 10 years thinks this is outrageous, and they are at least as independent as they were on day one. And it is a fairly blunt instrument. It's not one that even investors are a bit more flexible about it than perhaps they used to be. We did a study a couple of years ago, and I think 1 in 10 UK independent directors had actually been there more than 9 years, and nobody was in a particular. I mean, the main issue was if you've got loads of people who've been there for 15, 20 years, then you're not getting fresh blood, you're not getting fresh thinking. You've probably become a bit of a clique who will always support the long-serving management, irrespective of what they do. So it's there is a very blunt way of saying you need to refresh the board regularly.
Yes, there's a question here from Irene Marie Esser. Good to hear from you, Irene Marie. And she points to a recent legal case, which she says does confirm shareholder primacy, and she would like to see more alignment between the code and the Act in that respect. And also for the Act to allow incorporation of corporate purpose, not to hinder it. And so, yes, as Irene Marie, that's exactly what we are, along with many others, advocating for through the Better Business Act campaign. We want to see a change to this key part of the Companies Act 2006, which is the famous Section 172, which currently states that a director has a duty to promote the success of the company, which it sees as, well, is synonymous for many with the interests of the shareholders, but also, so we would like to see that part of the Act actually giving a more explicit recognition that the success of a company is about more than the success of just shareholders. It's actually about the success of a broad range of stakeholders that have a key role in the success of a business. But just a final question before we go on, Chris, from Turid Solvang. Hello, Turid. She asks, how about the FCA requirement for diversity on boards? Is that legislated or just a recommendation?
To my knowledge, and I'm not as up to date with some of the FCA requirements as I should be, there is a requirement to disclose diversity on the board, which is certainly part of the FCA rule book. I don't believe, unless things have changed relatively recently, that there are any requirements that specify the level of diversity on the board. So I would make that distinction. There are certainly requirements to disclose, what the board's diversity policy is, what they're doing about it, what the levels of their actual levels of diversity. There's no target or quota that I'm aware of that the FCA have set, though.
Well, it's certainly not like the Norwegian system, which basically stops stops you from operating as a company if you don't actually fulfill the quota required in the law. But okay, well, let's now move on. And if I can just move these slides. We're going to sort of turn away from the kind of legal and regulatory framework for a moment, just to discuss a few case studies, and I think case studies they've proven to be quite important in the UK context, because the way in which corporate governance has typically evolved is as a consequence of a series of corporate crises or scandals. This has been the case since the early 1990s, when series of scandals catalyzed the development of the first UK corporate governance code, and it's continued ever since. And much of the evolution of corporate governance tends to be about trying to learn the lessons of what's gone wrong in a particular high-profile case, and then making changes to the regulatory or the code environment. And on your screen there, you can see a number of companies that over the last, I would say, probably 8 or 9 years have run into all sorts of problems. They have been major scandals. Boohoo is a sort of fast fashion company that ran into problems during the pandemic in relation to its supply chain. Patisserie Valerie is quite a sort of upmarket coffee and bakery chain throughout the UK, which experienced a major fraud some years ago. Tesco, also another company that was castigated for treating its suppliers very, very badly and also manipulating its own earnings. GlaxoSmithKline was accused of bribery, pursuing bribery practices, in particular to sell its pharmaceuticals in China. But the two that I want to look at in a bit more detail are these other two on the right-hand side, BHS and Carillion, because it's these two cases that are now probably on the verge of prompting significant changes. At least that's what we've been led to expect by the government in the UK's corporate governance framework. So let's turn first of all to BHS. Now, you may remember BHS. BHS was a clothing store network throughout the UK, been around for an awfully long time, but in 2016 it collapsed, and it became insolvent. Hundreds of BHS stores across the UK were closed down. Many thousands of people lost their jobs, and there was a huge controversy. And what effectively happened was that a very well-known British entrepreneur called Sir Philip Green, there you see him there on the left-hand side, bought BHS back in the year 2000 and took it private. And for many years he ran BHS. He wasn't a particularly good steward of the business, I have to say. He didn't invest in the business. He extracted a lot of financial resources from the business through dividend payouts to himself and his family. And then as we moved into the 2010s, as the business was really starting to struggle, particularly relative to online shopping, he decided that he really needed to get rid of the business because it was costing him money. It had a significant pension fund deficit into which the business was required to contribute by the pensions regulator each year. So from his personal perspective, as the major shareholder in the business, it was depleting him of resources and he wanted to sell it. Unfortunately, he couldn't find anyone who was going to be a willing buyer for the same reasons that as he wanted to sell it. It wasn't a very attractive business anymore. Unlike some businesses that are taken into private equity ownership and then sort of revitalized and then returned in a buoyant state back to the market, the opposite had happened with BHS, and he simply couldn't find a buyer. Eventually, he did manage to find someone who would buy it, and that was this person on the bottom left-hand side, Dominic Chappell, who bought BHS from Sir Philip Green for £1, a nominal sum of £1. Now, of course, that was less of a good deal than it may sound at first sight, because along with the business came an awful lot of debt obligations and also the obligations to the pension fund. But nonetheless, Sir Philip Green was relieved because finally it was off his hands. Dominic Chappell, though, was completely unqualified to run a business. He had been bankrupt on several previous occasions. He started his career as a racing driver and got into all sorts of dubious business activities, and then found himself with owning BHS. He, over the course of the next 6 months, he then did really what Sir Philip Green had done previously. He extracted various funds from the company through dividend payouts. But after 6 months, the financial problems of the company just became too great. He wasn't able to find any bank or any other financier that would support the company, and then it was declared insolvent. And it was at that point that all the stores were closed, all the people lost their jobs, and it was a huge controversy. And what happened after that was, because of this was so high profile, the UK Parliament decided to conduct an investigation into why BHS had collapsed. And these are incredibly useful. These parliamentary investigations are very useful for us students of corporate governance, because often we don't see what's going on behind the scenes, behind the boardroom door, when a company is engaged in scandal or collapsing. But with one of these investigations, we're really able to get a kind of forensic analysis of what went wrong and what caused the company to collapse. And on this slide here, you'll see some of the highlights of what the parliamentary report concluded. So, as you can see, it concluded that Sir Philip Green hadn't been a very good steward of the company, that he had conducted all sorts of dubious transactions to extract value from the company, that the board of the Tavita Group, which was the private equity vehicle which ultimately owned BHS, Lord Grabiner, was nothing more than a token head of the board. And he, along with the other board members, exercised no check or balance over the main shareholder, Sir Philip Green, who was just allowed to do what he wanted with the company. So this was a classic example of the sort of bad old days of corporate governance, where boards were just appointed based on how they would look to the outside world, and the kind of vestige of respectability that they would provide to the outside world. So he was heavily criticised, and then of course the person to whom Sir Philip Green sold the company was hugely criticised. I suppose at the end of the day, Sir Philip Green probably thought that because he'd got BHS off his hands, that he would no longer be blamed for anything bad that subsequently happened to it. But unfortunately, that didn't prove to be the case. The blame remained very much at his door, and he was heavily criticised by this report. So that was the first. That was the first of these two case studies in 2016. Let me now just go on to our next case study, which happened 2 years later in 2018, just before the financial crisis. And this was the collapse of a company called Carillion. Now, Carillion was actually was a huge outsourcing company that really had established itself as sort of an outsourcing partner, in particular for the UK government, to provide the kind of public services such as running school meals, building hospitals, running facilities for government activities, which the government no longer wished to pursue and undertake itself, and which it preferred to outsource to the, in inverted commas, more effective private sector. So Carillion was adept at winning these sort of contracts, and it just grew from strength to strength, really from the sort of early 2000s onwards, well into the 2010s. Unfortunately, by the time we got to the late 2010s, it was in real financial difficulty. it was finding it very difficult to maintain its financial position, and in particular, its cash reserves. It was bidding for contracts, both in the UK and abroad, on very narrow margins. And even then, when it was winning those contracts, it was having a lot of problems in getting paid in time. Some major contracts it had in the Middle East, where it was owed huge amounts of money. And this eventually is a classic case of business failure, eventually caused it to run out of cash. It could no longer pay its bills. It could no longer pay its employees. And this all happened very suddenly in the sort of beginning of 2018, when in the middle of the night, the board just had to decide, as presumably it was just sitting there with its financial advisors, it simply decided it had to declare insolvency. And then that was the end of that. I think it had about £25 million left in its bank, which for a sort of multi-billion pound company was an absolute minuscule amount. So once again, this caused huge ramifications for the UK. Many suppliers were unpaid. Many people lost their jobs. All sorts of projects, major public and private sector projects were left in limbo. There was a huge hospital in Liverpool, which was sort of left semi-completed because Carillion had collapsed. So once again, the British Parliament wanted to know what has been going on here. And why was the government providing these contracts to Carillion, even in the relatively short period up to its collapse? What were the lessons that we need to learn about this? And I have to say, once again, the parliamentary committee placed the blame at the door of the board of directors. There were actually many actors that were culpable in this collapse, but first and foremost, it was the board of directors that failed to act as a meaningful check and balance on the company's management, that were really being quite reckless in the way they were expanding the business, and taking risks, playing Russian roulette effectively with the company's financial future. Of course, this didn't stop these executives from paying themselves very substantial bonuses and also paying out very significant dividend payouts to shareholders. And that was made possible because there was a good deal of manipulation of the financial reporting process, which was undertaken by the executives to make the financial position of Carillion look better than it was. And of course, this is something where the auditors also had to take some of the blame for not actually blowing the whistle on this kind of financial engineering and financial manipulation. Looking back on the collapse of Carillion, one of the kind of big red flags out there was how slowly Carillion was paying its suppliers. Now, Carillion had signed up to something called the Prompt Payment Code in the UK, which actually commits companies to paying their suppliers within 30 days. But actually, Carillion was sometimes paying suppliers after more than 100 days or even longer. That, a classic red flag, that this company is experiencing financial difficulties, so treat with caution. The auditors of Carillion, of course, were found to be at fault in not actually really doing what we all expect auditors to do, which is to provide assurance that the corporate reporting that the company is doing is robust and reasonable. And it was signing off on all the figures which were justifying substantial executive pay and also dividend payments. And the regulators in the UK also came in for a lot of criticism. The fact the Financial Reporting Council that oversees the auditing in the UK really was blamed alongside the auditor for really failing to have in place a sufficiently robust audit regime. And the pensions regulator was blamed because, in theory, if a company is running a pensions fund's deficit, as Carillion was, the pension regulator should insist that the company injects funds into the pension scheme to remedy that. And it wasn't doing that. It was letting Carillion off the hook again and again. So, you know, this was, I suppose, the feeling that came out of this was that these two cases, BHS and Carillion, represented some major failings on behalf of the overall framework of UK corporate governance. And that has motivated the government to come forward with proposals for significant reforms of how a variety of the elements of the system operate. And perhaps, Chris, will come on to what some of those reforms are just in due course. Back to you.
Yes, I mean, the moot question at the moment is whether we're going to see those reforms. As Roger said, I mean, some of them have come through already. The bullet point, that's the fifth one down there, that we've mentioned already, large private companies being required by law to report on their governance arrangements, is the one thing that has happened as a direct consequence of BHS. Prior to that, it was only listed companies that were expected to report publicly through a combination of the law, the listing rules, and the code. And it's linked a bit to the point we were talking about around whether it's shareholder primacy or not, because rightly or wrongly, the view prior to these changes in the law a few years ago was that if the board is accountable to the shareholders, then if you are a private company where the shareholders will by and large be represented directly on the board, there is no need for public accountability as well. And I think that what has changed is, from the case of BHS, the recognition that a large private company is just as capable of damaging the lives of their employees, pensioners, suppliers, and so on as a large private company. And so that the distinction didn't really make any sense. It was felt to say that you don't need to be accountable publicly for how you govern your company. So that's come in. A lot of the other things that Roger has talked about in both cases, the accountability of the auditors, and the board of directors to suppliers and others, have been built up as part of a package of changes that we are told will be coming forward. There were a number of reviews undertaken following Carillion into the effectiveness of the various regulators and so on. This has been promised for some time now. You may have noticed, as well as noticing that we're no longer in the EU, that we've been having a few, what's the polite way of putting it, a few fun and games, shall we say, with our political leadership over the last couple of years, which has slightly got in the way of making progress on these things. And there's been a fair bit of regulatory schizophrenia, I think, or at least political schizophrenia. On the one hand, they recognise the need to strengthen the law in relation to auditing and some of the things that came out of Carillion in particular, and there are proposals on the books ready to go. On the other hand, there is a keenness to position themselves post-Brexit as being less regulatory and less burdens on business and so on. And so there's a bit of a tension in political circles at the moment. So we don't know quite what will be coming out there. And that's sorry, I've lost my thread, Roger. Do you want to take over at that point?
Yes, no, absolutely. You know, of course, the other big change which is really making its impact felt in the UK relates to how companies address climate change. And what we've actually seen is that mandatory climate change reporting using the TCFD framework, so that's the Task Force on Climate Related Financial Disclosures, their framework for climate change risk reporting, that's been introduced and is now a requirement for listed and large private companies. I think, I mean, other things on that list, yeah, you know, we see within the corporate governance code, as I said before, an increasing recognition of the company's role in society, and that the companies need to be a good corporate citizen. You know, companies have to report their gender pay gap nowadays. They have to report the ratio of CEO pay to workforce pay. So that is all, I think, I think we'll see more of that actually in a likely future changes to the UK Corporate Governance Code, which I think, Chris, if I'm right, I don't know what your old colleagues at the FRC think, but I'm anticipating we're going to see another revision of the code next year, probably.
They have said there will be a revision. They haven't given a lot away as to what they will be looking at, other than the areas where they don't think companies are doing well enough at the moment. So you can read into that what you will. But the point about fairness, I think, Roger, is that you just made the link there, which has been an interesting development. Does link, I think, very much to the S in the ESG. You know, taking better care of the workforce, taking more interest in the workforce than perhaps has been the case previously. And certainly, as you say, the boards. The ESG, as opposed to just governance, is now very much a big part of their agenda. I've been talking to a lot of companies recently in relation to some other project, and many of them have said to us, 5 years ago, say, if you had an investor roadshow or the board agenda, you might have a little bit of time on sustainability or environmental issues right at the end, but it was very much last on the list, whereas it's much higher up the agenda for the boards, and only partly because of regulatory pressure, but partly as a recognition that they really need to address these if they themselves are going to be sustainable, but also for investors. And the point there about the stewardship code, it has linked to increased client demand for a lot of the big institutional investors for say, you need to be taking more interest in these issues when you're engaging with and investing in companies than perhaps investors have done in the past. I don't know, Carillion, whether you've discussed some of the developments at European Union level in this forum before, but there are a number of pieces of legislation coming through there or already in place that impact on investors as much as they do on companies in terms of decarbonising their portfolios and these sorts of things. So there is regulatory pressure on investors, including in the UK through the stewardship code, which now is very clear that they expect investors to put these environmental and social issues at the heart of their investment and engagement.
Chris, so maybe I could just jump in here just at that point to address. Actually, there's a question from Turid, who says, even if the UK is not part of the EU anymore, would you still consider implementing parts of EU CG regulations? I suppose I don't know what Chris thinks about this, but everything I've heard from governments is that the UK is not actually going to follow the EU example in some key areas. So, a big key piece of EU regulation at the moment is the Corporate Sustainability Due Diligence Directive, which is going to impose a requirement for EU companies to do due diligence of their supply chains. The UK government said it's not going to implement something similar in that respect, which in my view is a problem, but we'll start to see some divergence.
Yeah, no, I think that's right. I mean, politically, I think it's very difficult to see that happening, at least in the short term. I mean, there are some elements of what's in that particular piece of legislation from the EU that are in a much less, trying to think of the right phrase, much milder form already in the UK law, and that's the reference there to increased direct responsibility for individual directors was alluding to that. We have had something called a Modern Slavery Act in the UK for a number of years, which is, as I say, a very watered down version of what the EU is proposing in terms of due diligence for human rights in the supply chain. There is equally a Briberies Act, which makes individual directors directly accountable for bribery wherever it's carried out in the world. So there are some elements there. They're not as forceful as the EU proposals. You could conceivably see the UK government saying we're going to strengthen our existing domestic legislation, although even there I'm not sure how much appetite there is for that. They've all become a bit sort of self-absorbed, so it's probably not top of the list just at the moment, unfortunately.
Yes, there are two further questions. Perhaps we could just deal with them together. So the one question from Boon Yi Lai, which is, what is the right composition of the board in terms of executive and non-executive directors? And Raymond Ho asks, excuse me, Does the company
Right,
secretary? Yes, the frog has just suddenly found its way into my throat there. Does the company secretary play the role of ESG sustainability head? Chris, any thoughts on either of those?
Yeah, I'll take the easier one first, which is Raymond's question. I think it very much depends on the size and sector of the company. In my experience, talking to large listed companies now, most of them will have a separate head of sustainability or ESG, but they have the resources to do that. They have a lot of attention from regulators and investors that puts that, makes it almost a necessity for them, as well as the regulatory reporting, like the TCFD that Roger mentioned. There's an increasingly prominent role being played by ESG rating agencies who provide services to investors who send in forms that have hundreds of questions that companies are asked to fill in. So larger companies, and particularly those in sectors which have an obvious environmental impact, there'll tend to be a separate person. For smaller companies, it will typically still be the company secretary who carries out that role. So a partial yes, Raymond, I think, is to your question. As for Boonie Lee's, it depends who you ask, I think. I mean, in some of the continental Europe, where you have a two-tier board, obviously they will say, well, the two elements should be kept separate. In terms of the UK, in listed companies, the practice, and I'm not saying that this is the right practice, the practice is that typically you will have the CEO and the CFO on the board, and it's quite unusual to have any other executive directors there. And as I say, there are pros and cons to this. One of the perceived disadvantages of this is that there's less direct engagement with other members of the senior management team, for the non-executives to build relationships with and establish the capabilities of the senior management team. People who are opposed to having more executives saying, well, nobody's going to turn up and actively disagree with the CEO in front of the rest of the board, are they anyway? So there's no real value from having them there. The important thing is to get them in on a regular basis for relevant items. So I don't know that there's a right answer to that one.
Yeah. Well, thank you, Chris. Caroline, I think we've run out of time. I've just put up some information about the Institute of Directors, and this is where you can find us online.